Hey, welcome back. It's Jason Walter here. I have some fairly breaking news to share with you today because just yesterday they announced a brand new bill that's a first-time homebuyer credit for $15,000. This is quite a bit different than the $25,000 credit that was a proposal that was announced about a week ago, and I made a video about that as well. In any case, this video is about this brand new $15,000 first-time homebuyer credit, and I'll provide you with all the details in today's video. The best way to share this information with you today is to share my screen with you. So let me do that right now. So here's a press release from U.S. Congressman Earl Blumenauer. He represents the 3rd District of Oregon. He just released this yesterday at the time of this video. So it says here, as home sales and prices continue to surge across the country, first-time home buyers are struggling to break into the unprecedented housing market. Yes, it's very challenging right now to get offers accepted, given the fact that we have such high buyer demand in the U.S., right? Today, U.S. Representative Earl Blumenauer, who is a Democrat from Oregon, a senior member of the House Ways and Means Committee, alongside Representative Jimmy Panetta, who represents California, introduced new legislation to support these buyers with a first home buyer tax credit. Again, this is a lot different than the up to $25,000 tax credit that I went over in my previous video. All right, so this is a refundable tax credit up to $15,000. Of course, this is a first-time home buyer program, and it's called the First Home Buyer Act. As home prices and demand continue to rise to historic levels, we need to do more to create opportunities for those who've been locked out of home ownership by creating incentives for first-time home buyers. They mention here they want to narrow the gap between white communities and communities of color, because obviously there is a big disparity on home ownership of white communities versus communities of color. So we're trying to do something about that. All right, so let me share a couple of details about this, and then I'm gonna be actually sharing my screen because I actually found the actual text of this bill with you, so I'll provide all the details for you. So this is really interesting to see here because they say that taxpayers may elect to treat the purchase of their home as occurring in the prior taxable year to receive the credit sooner. So let's just give you an example here. So let's just say this is for, by the way, for people who buy a house on or after December 31st, 2020. And this is just a bill, it hasn't been approved yet. In any case, this is a key point here in this press release here though, because let's just say you buy a house on January 1st, 2021, and you haven't done your taxes from the prior year. So you could purchase a house and then file your taxes for 2020 and then get the credit when you file your taxes for 2020. So rather than waiting for a year or longer to file your 2021 taxes. So I hope that makes sense. Families eligible to take the full credit are those who have not owned or purchased a home within the prior 3 years before the purchase. Also, there's income limitations as well of 160% of the area median income, and the purchase of the house must be at or below 110% of their area's median purchase price. Now, I'll go over that here in just a little bit. All right, let's share the actual text of the bill that I actually found itself. 14 pages long, so I'm making this video so you don't have to read every single word of this legislation or this bill. All right, so this is again from Mr. Blumenauer, introduced this following bill. This bill is called the First Time Homebuyer Act of 2021. It's a refundable tax credit, as I mentioned before, and the amount of the credit is equal to 10% of the purchase price of the residence, but not to exceed $15,000. And if you're married and you're filing a separate return from your spouse, you're only qualified for up to $7,500. They don't want married couples to double dip, right? So if you are married, you buy a house, then they don't want you to file for two $15,000 credits. You only can get $7,500 per individual. In addition, if two or more individuals who are not married purchase a primary residence, the amount of the credit allowed under this subsection shall be allocated among such individuals in such manner as the secretary may prescribe. Again, but it cannot exceed $15,000. All right, so there are limitations based on the area median income. So let's talk about that. So the credit allowed under this to the taxpayer is based on your modified adjusted gross income. And that amount cannot exceed 160% of the area median income. So I have some examples to share with you regarding this. So the area median income, they have a AMI lookup tool on the Fannie Mae's website. I'll leave a link below for this in case you want to see what your area median income is for your neck of the woods. But in Sacramento, where I live, our area median income is $86,700. Based on the limitations on income, it's 160%. So you multiply that by 1.6, and that's 138,720. So if you make less than that, you would qualify that based on income limitations. If you make more than that, you would not qualify. Hope that makes sense. Another example for, this is Las Vegas. Yeah, Las Vegas. The area median income is $70,800. So you multiply that by 1.6, and then your area median income limitations for this program or this act is $113,280. So I'll leave a link below to this so you can see what your area median income is, see if you qualify. All right, so there are also limitations based on the purchase price, the median purchase price. And this is really interesting. I have some questions about this because the language of this is a little bit vague. So leave me a comment below with any questions though. In any case, the area median income purchase price cannot exceed 110% of the area median purchase price. So for example, in Sacramento County, where I live and work as a real estate agent, our area median income in Sacramento County is $481,000. So 110% of that is $529,100. So you would have to purchase a home in Sacramento County for less than $529,000 in order to qualify for this program. However, of course, it just depends on your area and the area you want to purchase in, right? So let's talk about this. So the term area median purchase price, it means the average purchase price for a home in both the area and the calendar year in which the purchase of the primary residence takes place. Keyword there is area, right? So if I'm buying a house in Sacramento, does this mean the area as in my neighborhood that you're buying a house? Does this mean the city you live in? Or does this mean the county you live in? Very vague language here. So it'll be interesting to see how they really define this, if it gets approved, of course, too. But it does say here the Secretary, after consultation with the Secretary of Housing and Urban Development, will help set the purchase price limitations. So we'll see about that. There's also an inflation adjustment for if you buy a house after the calendar year of 2021. So I won't go over that. I'll leave a link below if you want to read about that. You also have to be at least age 18 by the time you purchase this house or a house. Again, it's a first-time homebuyer program. And they define a first-time homebuyer as someone who has no present ownership interest in any residence during the 3-year period ending on the date of the purchase of the primary residence. That also includes your spouse as well. Again, principal residence. It also applies to construction too. So if you buy a plot of land and you build a house, they also would consider that a first-time home purchase if that is your first time buying a house. They would consider that on the date the taxpayer first occupies such residence. In addition, there's some exceptions. So some people may not qualify for this credit based on certain criteria. Again, I'll leave a link below for this. So one example in which you would not qualify for this tax credit is if you don't file your tax returns properly. So it says a taxpayer fails to attach to the return of tax for such taxable year a properly executed copy of the settlement statement used to complete such purchase. So if you buy a house, there's what's called a final closing statement that you get from your title company or your attorney, depending on where you live. In any case, when you file your tax returns, you must attach that to your tax returns to basically prove that you purchased the house. Here's something I found very interesting, and it's super important here, so definitely make sure you're aware of this. And they have what's called a recapture of credit. So in other words, you have to live in the house for at least 4 years. If you move out previous to that, you may have to pay back some of this credit that you received when you purchased the house. All right, let's say you buy a house and then you actually end up moving before this 4-year period. There are some certain exceptions to this, but let me kind of break down how this all works. So the recoverable amount that they would require you to pay back is based on 25% of the amount of the credit multiplied by the number of taxable years remaining in the recapture period as of the beginning of the taxable year in which a taxpayer disposes of the principal residence. So in other words, as each year goes by, 25% can get knocked off the amount you have to pay back. All right, so exceptions, of course, there's some certain exceptions to this rule. The death would be one of them, involuntary conversion, transfers between spouses or due to divorce. There's also special rules for members of the armed forces. And if you have a change of employment, you also may be eligible for an exception to this rule. Joint returns. So in the case of a credit allowed with respect to a joint return, half of such credit shall be treated as having been allowed to each individual filing such return for purposes of the subsection. So in other words, if you file a joint return, you only get one credit. You don't get 2 credits per spouse. In addition, let's talk about timelines here, right? So this first-time homebuyer credit only applies to a principal residence, so not investment properties, purchased by a taxpayer on or after December 31st, 2020. Okay, let me share my biggest takeaways regarding this and give you a summary about all of that because there's a lot in there, right? So this is a $15,000 refundable first-time homebuyer credit, right? It's up to $15,000 though. It cannot exceed 10% of the purchase price. In addition, this is for first-time home buyers, and they define that as those who have not owned a home in the previous 3 years. And again, this is a principal residence only, not investment properties. On top of this, the area median income, there's income limitations, right? So the area median income cannot exceed 160%. So if you earn more than 160% of your area median income, you may not qualify for this program. In addition, there's a 110% cap on the area median purchase price. So you look up your area's median purchase price, and I don't know if that's a neighborhood, county, city, whatnot. We should get more information about that if this does get passed. However, there is a cap of 110% of the area median income. I'll leave a link below for that Fannie Mae lookup tool for you. So let me give you an example. For Sacramento, those who make less than $138,000 for their adjusted gross income would qualify for this program based on income limitations. Of course, you have to be a first-time home buyer, of course, as well. In addition, you must purchase a home based on the data we have right now for Sacramento County of $529,000 or less. So if you buy a house for more than that, you may not qualify. Again, we have to see what the area means, but that's basically a rough estimate for you. In addition, there's a recapture period of 4 years, so it reduces by 25% per year. So if you live in the house for at least 4 years, you do not have to pay back this up to $15,000 credit. In addition, this is for home purchases on or after December 31st, 2020. However, the big takeaway is you can treat this as purchasing the house in the previous year in order to get the credit sooner. So if you bought the house in, let's say, March 2021, then when you file your 2020 taxes, if you haven't filed those already, then you can get this credit when you file your 2020 taxes rather than getting the credit when you file your 2021 taxes. Another key takeaway here is that this is not an approved bill yet. So it does have to be approved by the House, Senate, and then also President Biden has to sign it into law before it actually becomes a law where people can actually take advantage of this program. However, this is a big step above the Down Payment Towards Equity Act of 2021 that was announced about a week ago that I made a video about. That was because that proposal of up to $25,000 credit was just an idea. It wasn't even a bill. However, this is a bill that can be approved or voted on. So it is a big step in the right direction if you do want to have a home buyer credit received. In addition, this bill has no mention of a requirement of being a first-generation home buyer. The Down Payment Towards Equity Act of 2021 did have that as a requirement. And here's my last takeaway for you. So if this does actually get passed, this could increase home buyer demand, and that could cause home prices to increase. So in my opinion, this is a double-edged sword. So you can get money when you file your taxes if you do qualify for this program and if it does get approved. However, home prices could increase because this could increase home buyer demand. If you enjoyed watching this video, please hit the like button. I greatly appreciate that. And also consider subscribing if you haven't done so already. You also can follow me on Instagram. I'm Sacramento Realtor. Hope you have an awesome day, and I look forward to seeing you on the next video.